Welcome to First Union Lending. My name is Trizia, and today we're talking about the 3 types of financial statements for your small business. Don't forget to like and subscribe to our channel for more weekly videos on small business funding. In terms of record keeping, there are 3 must-haves for any business. Keeping tabs on all finances is very important for the economic health of the company. You want to know exactly where you stand, what projections might look like based upon past and current models, and what might need adjusting in terms of money coming in versus what is going out. This is where business financial statements come into play. The 3 types of business financial statements you want to keep current are income statement, cash flow statement, and the balance sheet. Let's discuss each one and explain what their key features are. Number 1, income statement. It is developed to show a business's profit and loss over a certain specified period, which is why it's also known as a profit and loss statement. You include all sales revenue and then deduct all of your expenses and consequent losses. There are several generic items commonly seen in any income statement. These include revenue, cost of goods sold, gross profit, marketing and advertising expenses, income taxes, and net income. Generally, a business will need an income statement if they are trying to get a loan from a lender or investor, as the loaner will want a concise idea of how much money the company is making. Number 2, cash flow statement. This shows your liquidity, which is what you have on hand for available funds. It essentially lets you know how operations are running, where your money comes from, and how it's being spent. The 3 main components of the cash flow statement are cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Cash flow from operating activities is thought to be the most important section. It can be calculated using the direct or indirect method. The direct method involves taking all the cash collections from operations and subtracting all the cash disbursements from operations. The indirect method requires you take your net income from the income statement and make adjustments to undo the impact of the accruals made during the reporting period. Both methods will give you the same number, but the indirect method is typically faster. Number 3, balance sheet. You might think of a balance sheet as the big picture of where your company stands financially at any given time. It is typically divided into assets, liabilities, and owner equity. Assets include any money in the business account, inventory, stocks and bonds, accounts receivable, long-term investments, and equipment, among other items. Liabilities generally involve accounts payable, wages owed to employees, taxes, loans, and other such debts. And finally, the equity is that which belongs to the business owners. This might include private stock owned, money you've invested in the company, as well as retained earnings. In the end, the total assets should balance out against liabilities plus owner equity. Financial statements are a key tool for managing your business and planning its future. They're also required by tax authorities and many financing partners. If you're looking into business funding, First Union can help. First Union Lending offers numerous financing programs designed with small businesses in mind. Our business loans are fast and flexible, with financing options ranging from $5,000 to $2 million. Call today to learn more about our various financing solutions to help your business grow and become successful.